Hi, I'm Dan Passarelli of MarketTaker.com here on the floor of the CME Group. Well, one of the trades we talked about today in our Market Taker Live Advantage Group coaching class was in Tesla Motors, symbol TSLA. Tesla had been having a pretty deep slide recently. The stock really fell a lot, but it bounced and had a reversal candle at around its support level of $160 a share. The volatility spectrum sets up nicely also for a potentially great trade. The implied volatility is high, probably as a result of two things. One, the slide we've seen recently, and B, the fact that earnings is coming out next week. Now, the trade I like is selling the 155-160 put spread with the November 1st expiration. So this expiration is just in a couple of days. It's right around the corner. Now, I mentioned implied volatility being high because of earnings, but earnings is next week. Expiration is before earnings. When a trader puts on a credit spread like this, they always want the expiration to be before the earnings so that you don't have that earnings related risk. I love this trade because the options are so expensive, because we have that strong support at $160 a share, and the trade only lasts a couple days. As long as the stock doesn't fall below 160 between now and expiration, the trade's a winner. If, however, that route ends up to start to continue and the stock does fall below 160, as soon as it falls below 160, I would close this trade out, take a small loss so a bigger one doesn't ensue. With a couple days of time decay, you might not have that big of a loss at all. So this is a potentially great trade with a really great risk reward. I think if you can sell this trade anywhere above $1.50, I think it's great. So there's potentially a pretty meaty profit there. Right about now, you can get probably do a little better than that. And you know, the risk of loss is pretty low because it's such a short-term trade. This is Dan Passarelli of MarketTaker.com here on the floor of the CME Group.